Why Warren Buffett's $700 billion investment empire built on value. In 1965, a young investor named Warren Buffett made what he would later call the worst investment decision of his career. He bought control of Berkshire Hathaway, a struggling textile manufacturer in New Bedford, Massachusetts, not because he believed in its future, but out of spite during a petty disagreement over the share price. The company was hemorrhaging money, competing against cheaper overseas labor, and appeared destined for the corporate graveyard. Yet, from this unlikely foundation, Buffett would construct the most successful investment empire in modern history, transforming a dying textile mill into a conglomerate worth over $700 billion. This is the story of how patient capital allocation, unwavering discipline, and an almost supernatural ability to identify undervalued companies created the ultimate investment vehicle and made its shareholders extraordinarily wealthy over 5 decades. The Berkshire Hathaway that Buffett acquired was already a century-old relic fighting an unwinnable war. Founded in 1839 through the merger of two New England textile companies, it had once been a pillar of American manufacturing. But by the 1960s, cheap foreign competition was crushing the domestic textile industry, and Berkshire was burning through cash trying to stay afloat. The company's stock price had fallen from over $40 per share in the 1940s to around $8 when Buffett began accumulating shares. Seabury Stanton, the company's CEO, had been buying back shares as they declined, and it was during one of these buyback offers that the fateful disagreement occurred. Stanton had verbally agreed to buy Buffett's shares at $11.50 each, but when the formal tender offer arrived, it was for only 11 and an eighth. Insulted by what he saw as Stanton's attempt to save a few cents per share, Buffett decided to buy control of the entire company instead. By 1965, at age 34, he owned 60% of Berkshire Hathaway and fired Stanton, setting in motion one of the greatest wealth creation stories in business history. Rather than pour more money into the dying textile business, Buffett began using Berkshire's cash flow to acquire stakes in other companies. His investment philosophy was elegantly simple: buy wonderful businesses at fair prices, or fair businesses at wonderful prices, then hold them for decades while their intrinsic value compounded. This approach flew in the face of Wall Street's prevailing wisdom, which favored frequent trading, market timing, and complex financial instruments. Buffett's first major acquisition through Berkshire came in 1967 when he purchased National Indemnity, a small insurance company, for $8.5 million. This seemingly modest purchase would prove transformative because insurance companies collect premiums upfront and pay claims later, creating what Buffett called float, billions of dollars that could be invested while waiting to pay future claims. By 2020, Berkshire's insurance operations would generate over $130 billion in float, essentially providing Buffett with a massive, low-cost loan to fund his investments. The insurance business became the engine that powered everything else, allowing Berkshire to buy entire companies and massive stock positions without diluting shareholders or taking on debt. The 1970s marked Berkshire's emergence as a serious investment force as Buffett began accumulating positions in undervalued public companies. His investment in the Washington Post Company exemplified his approach. In 1973, amid a brutal bear market, the Post's market capitalization had fallen to around $80 million, even though Buffett estimated the company was worth at least $400 million. He began buying shares aggressively, eventually owning nearly 12% of the company. The investment would return over 100 times his money over the following decades as the newspaper industry enjoyed its golden age. Similarly, his 1976 investment in GEICO, the insurance company he had first visited as a 20-year-old Columbia student, demonstrated his willingness to bet big on companies he understood deeply. GEICO was hemorrhaging money and facing potential bankruptcy when Berkshire invested $45 million for a significant stake. Under new management, GEICO recovered spectacularly, and Berkshire eventually bought the entire company for $2,300 million in 1996. These investments established the template for Berkshire's success. Identify excellent businesses trading below their intrinsic value, buy large positions, and hold them while management compounds the underlying value. The 1980s saw Buffett refine his strategy further, moving beyond purely statistical bargains to focus on businesses with durable
competitive advantages, or economic moats. His 1988 investment in Coca-Cola represented this evolution perfectly. Coca-Cola wasn't particularly cheap when Berkshire began buying, trading at about 15 times earnings, but Buffett recognized it as the ultimate franchise business with an unassailable global brand and enormous pricing power. Over 13 months, Berkshire invested $1,300,000,000 to become Coca-Cola's largest shareholder with a 7% stake. The investment seemed expensive to many observers, but Buffett understood that Coca-Cola's earnings would compound at attractive rates for decades. By the late 1990s, the position was worth over $13 billion, and the annual dividends alone exceeded Berkshire's entire original investment. The Coca-Cola investment demonstrated Buffett's ability to think like a business owner rather than a stock trader, focusing on the long-term earning power of exceptional franchises rather than short-term price movements. As Berkshire's capital base expanded, Buffett increasingly focused on acquiring entire businesses rather than just stock positions. The 1990s brought a series of major acquisitions that transformed Berkshire into a true industrial conglomerate. The purchase of See's Candies in 1972 for $25 million had been an early template, generating enormous cash returns that funded other investments. Building on this success, Berkshire acquired Nebraska Furniture Mart, Borsheim's Jewelry, and other businesses with strong market positions and exceptional management teams. The 1995 acquisition of GEICO for $2,300,000,000 was followed by General Re in 1998 for $22 billion, making Berkshire one of the world's largest reinsurance companies. These wholly owned subsidiaries provided steady cash flows independent of stock market volatility while allowing their managers to operate with unusual autonomy. Buffett's management philosophy was simple: hire exceptional people, give them clear financial targets, then leave them alone. This decentralized approach allowed Berkshire to operate dozens of different businesses efficiently while maintaining the entrepreneurial spirit that made them successful in the first place. The 2000s brought new challenges as Berkshire's enormous size made it increasingly difficult to find investments large enough to move the needle. With a market capitalization approaching $100 billion by 2007, Buffett needed to deploy billions at a time to generate meaningful returns. The 2008 financial crisis provided exactly such opportunities as panic gripped global markets and many blue chip companies faced liquidity crunches. Buffett emerged as a white knight for several iconic American businesses, providing desperately needed capital in exchange for attractive terms. He invested $5 billion in Goldman Sachs preferred stock, yielding 10% annually, plus warrants to buy common shares. Similar deals with General Electric and Bank of America generated billions in profits while helping stabilize the financial system. Perhaps most significantly, Berkshire began accumulating a massive position in Apple starting in 2016, eventually owning over 5% of the technology giant for around $36 billion. By 2021, this stake was worth over $100 billion, making it Berkshire's largest holding and demonstrating that even in his 90s, Buffett could adapt his investment approach to new industries.
What set Buffett apart from other investors wasn't just his stock picking ability, but his unique approach to capital allocation and corporate governance. Unlike typical public companies that paid regular dividends, Berkshire retained virtually all its earnings to fund new investments, allowing shareholders to benefit from tax deferred compounding. Buffett argued that as long as Berkshire could reinvest earnings at rates exceeding what shareholders could achieve elsewhere, retaining profits made more sense than paying dividends. This strategy proved extraordinarily successful over decades, with Berkshire's book value per share growing at a compound annual rate of over 19% from 1965 to 2020, compared to 10% for the S&P 500. The company's annual shareholder meetings became legendary gatherings where tens of thousands of investors traveled to Omaha to hear Buffett and his longtime partner Charlie Munger dispense investment wisdom. These meetings, dubbed Woodstock for Capitalists, helped create an almost cult-like following among shareholders who trusted Buffett's judgment implicitly and held their shares for decades rather than trading frequently. The numbers behind Berkshire's success are staggering and speak to the power of compound returns over extended periods. A single share of Berkshire Hathaway purchased for $19 in 1965 would be worth over $500,000 by 2021, representing a compound annual return of approximately 20% over 56 years. This means that $10,000 invested in Berkshire at the beginning would have grown to over $270 million, compared to about $1,300,000 if invested in the S&P 500. Berkshire's market capitalization grew from around $20 million in 1965 to over $600 billion by 2021, making it one of the world's most valuable companies alongside Apple, Microsoft, and Amazon. The company employs over 370,000 people across dozens of wholly owned subsidiaries, generating annual revenues exceeding $250 billion. Buffett's personal stake in Berkshire, representing about 16% of the company, made him one of the world's wealthiest individuals with a net worth exceeding $100 billion, though he has pledged to give away 99% of his wealth through the Giving Pledge initiative he co-founded with Bill Gates. Warren Buffett's transformation of Berkshire Hathaway from a failing textile company into a $700 billion investment empire stands as perhaps the greatest example of wealth creation through patient capital allocation in business history. His success wasn't built on technological innovation, financial engineering, or market manipulation, but on the simple principle of buying excellent businesses at reasonable prices and holding them while their intrinsic value compounded over decades. The Berkshire model proved that in a world obsessed with quarterly earnings and short-term results, enormous wealth could be created by thinking like an owner rather than a trader. Buffett's annual letters to shareholders became masterclasses in business analysis and investment philosophy, influencing generations of investors and managers worldwide. His famous quotes, "Our favorite holding period is forever," "Price is what you pay, value is what you get," and "Time is the friend of the wonderful business," captured the essence of long-term value investing in an era dominated by speculation and momentum trading. As Buffett enters his 90s and gradually transitions control of Berkshire to younger managers, his legacy is secure as the investor who proved that boring, patient, disciplined capital allocation could create extraordinary wealth for those willing to think and act like business owners rather than stock traders. The Berkshire Hathaway story demonstrates that in the world of investing, as in many areas of life, the tortoise really can beat the hare when armed with superior judgment, infinite patience, and the courage to act decisively when opportunities present themselves.